The largest emergency oil release in history was triggered by a weapon that was never fired. 400 million barrels. A number so large it broke every previous record by a factor of 2. Released in a single coordinated response by the world's most powerful economies. And the weapon that caused it? Still loaded. Still aimed. Still hasn't gone off. That is what's actually happening in global energy markets right now. And almost nobody is explaining it clearly. I'm going to change that. Number. You've heard about the Strait of Hormuz. The whole world has been watching Hormuz. But the most dangerous weapon in this crisis isn't Hormuz. It's a 26-kilometer channel at the southern tip of the Red Sea called the Bab el-Mandeb. You probably haven't heard that name on the news. That's exactly the problem. Because here's what our analysis found. The actors who control that channel have made a deliberate decision. Not to fire, not yet. Not because they can't, because the threat of firing it is currently worth more than actually pulling the trigger. That one decision, to keep a loaded weapon holstered, is the most important thing happening in energy markets today. And we're going to walk through exactly what it means, what it would take to change it, and what you should actually be watching. This isn't a prediction, it's a stress test. Here's how to read it. A stress test doesn't tell you what will happen, it tells you what to watch. Which signals matter, which thresholds are real, which narratives are covering up the actual physics of the situation. Our framework models a scenario where military operations in the Middle East have disrupted flows through the Strait of Hormuz, driving oil toward $120 per barrel before a partial pullback into the high 80s. 2 major developments happened today that directly update that model. The first, a record international emergency response, the biggest in history. The second, a weapon that hasn't been fired. And why that tells you more than the one that has. Let's start with the number everyone is talking about. Today, IEA member countries announced a coordinated release of 400 million barrels of emergency oil reserves. To understand how big that is, the previous record was 182 million barrels, released after Russia invaded Ukraine in 2022. Today's number is more than double that. It's roughly 22% of all emergency stocks held by Western economies, deployed in a single move. In our analysis, we identified a specific early warning indicator for Western alliance cohesion. Does the IEA convene an emergency meeting and announce a coordinated release within the first week of a major Hormuz disruption? That indicator just fired, and it fired bigger than our baseline assumption. So, good news, right? Here's what it actually does, and doesn't do. It does not reopen a single shipping lane. It does not move one tanker through the Strait of Hormuz. It does not change the war risk premium that insurance underwriters are charging on vessels in the region. The IEA chief himself said it plainly. A durable solution requires, and I'm quoting, restoring normal transit through the Strait of Hormuz. The largest emergency oil release in history is a time-buying tool, not a solution. The real question is, what is that time being used for? And is it enough? When oil fell from above $100 back toward the high 80s this week, markets read it as relief, a sign the crisis was being managed. Our analysis reads it completely differently. Here's what actually happens at $120 per barrel. The global economy doesn't wait for shipping lanes to physically close. It starts pricing in what comes next. Industrial companies cancel forward orders. Shipping companies idle vessels. Manufacturers cut production schedules. Demand starts collapsing. And when demand collapses faster than supply constraints fully manifest, prices drop, not because the crisis is over, because the economy is already beginning to contract. In financial markets, this is called demand destruction. A price drop during an active physical disruption is often a warning signal, not a green light. Think of it this way. The fire alarm goes off. Panic. Prices spike. Emergency services arrive, make announcements, open some windows. Things get quieter. Prices fall. The fire is still burning. The 400 million barrel release is the window being opened. It buys time. It creates breathing room. It does not put out the fire. The price retreat is not resolution. It's the economy flinching. To understand where this goes from here, you need to understand 2 fundamental forks in the road. Everything else flows from these. Fork 1, supply shock containment. Does the disruption stay bounded to Hormuz, or does it expand to the Bab el-Mandeb? If Hormuz closes, Saudi Arabia has a backup, the East-West pipeline, crossing the Arabian Peninsula to the Red Sea port of Yanbu. From there, oil moves northward through the Suez Canal to European markets. That bypass is real. It works. It provides genuine relief for Europe. But here's the critical finding from our analysis. That bypass does nothing for Asia. China, India, Japan, South Korea, the economies most exposed to this crisis, need oil moving southbound out of the Red Sea into the Indian Ocean. If the Bab el-Mandeb closes, that route closes with it. The bypass doesn't trap the oil, but for the world's largest energy importers, it might as well. Fork 2, Western Alliance cohesion. Do G7 economies coordinate, joint releases, unified diplomacy, shared rationing, or does each nation pursue its own survival strategy and fracture the coalition? Today's IEA announcement moves Fork 2 toward coordination. Fork 1 is completely open. Before we go further, quick question. Had you heard of the Bab el-Mandeb before today? Drop it in the comments. I'm genuinely curious how underreported this is. Our analysis identified the Houthi movement in Yemen as the pivot actor, the entity whose decisions determine whether Fork 1 closes. Here is what we anticipated, and here's what's actually happening. As of today, the Houthis are not executing a sustained maritime interdiction campaign. They are threatening one. That distinction is more important than it sounds. They have stated publicly that they retain the missile and drone capabilities from their 2024-2025 Red Sea campaign. They have threatened to resume large-scale attacks, and they've said that the operational pause, in place since late 2025, could end at any time. Reporting indicates an active internal debate. Hardliners pushing for immediate escalation. Pragmatists warning that full-scale attacks would provoke a military response that destroys recent political gains in Yemen. That internal tension produces a state our original model didn't cleanly anticipate. We're calling it calibrated interdiction. Sporadic, selective strikes sufficient to keep insurance premiums elevated, without triggering the full military response that a complete closure would bring. This third state is, in some ways, harder to manage than a clean closure. A clean closure sends a clear signal. Governments respond, navies deploy, diplomatic back channels open. Calibrated interdiction creates ambiguity. Insurance underwriters price in elevated risk, but not maximum risk. Shipping companies reroute some vessels. Markets can't fully price the threat, and governments can't clearly respond to it. And this is the insight that reframes the entire IEA announcement. The largest emergency oil reserve release in history was triggered, at least in part, by a chokepoint that hasn't been fully activated. The Houthis didn't need to launch a sustained missile campaign to force a record international response. The threat alone was enough. That is what option value looks like in a geopolitical crisis. Based on our updated analysis, here is where the 5 scenarios stand. These are stress test estimates, not predictions. Scenario 1, contained attrition, 38% probability, Hormuz stays disrupted. Bab el-Mandeb stays open. The IEA coordination holds. A negotiated off-ramp materializes within 12-18 months. Oil stays between $90 and $130 per barrel. Painful, but manageable. The Houthi pragmatist faction wins the internal debate. This is the most probable path. Today's IEA announcement moved it higher. Scenario 2, fractured siege, 12% probability Hormuz disrupted, Bab el-Mandeb open, but the G7 fractures, each nation for itself. Today's announcement reduced this probability. It hasn't eliminated it. Watch the US contribution figure when it's disclosed. That number tells you whether today's coordination was real or partly cosmetic. Scenario 3, hermetic seal, 25% probability. Both choke points close. The Saudi bypass loses its southbound exit. G7 coordinates, but coordination cannot substitute for a 20 million barrel per day physical deficit for Asian buyers. This scenario produces a global recession. Not whether, but how deep and how long. There's a critical mechanism most coverage misses. Any strike on Yemeni port infrastructure, designed to degrade Houthi capability, may actually resolve the internal debate in the hardliners' favor. Military action intended to prevent escalation could accelerate it. That's a structural paradox our analysis keeps flagging. Scenario 4, Cascade Collapse, 12% probability. Both choke points close and the G7 fractures simultaneously. Sovereign resource hoarding triggers cascade defaults in energy derivative markets. Major economies face a binary choice: absorb the damage or take drastic action. This is the scenario that permanently restructures the global order, not through intention, but through the cascade logic of economic survival. Scenario 5, calibrated stalemate, 13% probability. This one wasn't in our original framework, worth acknowledging directly. The Houthi calibrated interdiction posture continues indefinitely. Sporadic strikes keep Red Sea premiums elevated. The crisis becomes a sustained background condition, not an acute emergency. Markets partially adapt, supply chains partially reroute, but the underlying vulnerability never resolves. In some ways, this is the most insidious scenario of all. Not a crash, a slow bleed. Here's what you should actually be watching. Not the headline price, not the political statements. Tripwire 1. The insurance circuit breaker war risk premiums on Red Sea and Hormuz routing. When they exceed roughly 10% of hull value, commercial shipping stops. Not because of missiles, because no company sends a $200 million vessel into a war zone without coverage. Today's IEA release has not moved this number. Watch this, not WTI or Brent. Tripwire 2. Houthi strike tempo. Not the rhetoric, the tempo. Statements are cheap. A sustained, systematic attack pattern is operationally expensive and signals a strategic commitment. The shift from sporadic strikes to systematic campaign is the moment Fork 1 begins closing. Also watch this. Any major strike on Yemeni port infrastructure. That's a leading indicator that the Houthi internal debate may resolve, hard, in the wrong direction. Tripwire 3, the interceptor depletion clock. Regional missile defense systems have finite stockpiles. When inventories fall below roughly 14 days of sustained combat capability, the situation reaches a binary: unconditional ceasefire or extreme vertical escalation. There is no middle path after that threshold. Tripwire 4, the US SPR contribution disclosure. Today's announcement didn't specify individual country contributions. When the US number is disclosed, it tells you whether the coordination is deep or partially cosmetic. A proportional US contribution confirms genuine depth. A minimal contribution retroactively weakens the signal and quietly increases the probability of fractured siege. Every Western analysis underweights the same actor: China. China's economy is more exposed to this crisis than nearly any other. At $120 per barrel sustained, Chinese industrial output contracts. At $150, it becomes a political problem for Beijing. And China holds leverage that no Western power can replicate. It is Iran's primary remaining economic partner. In our analysis, the most likely long-term resolution mechanism in the contained attrition scenario isn't a military outcome or a direct diplomatic breakthrough. It's Beijing deploying economic pressure on Tehran when China's own pain threshold is reached. There's a second, lower probability version of this story, roughly 15%. If the crisis extends long enough and Western military assets are visibly exhausted, China faces a structural choice: continue absorbing economic damage or deploy naval escorts to physically protect its own supply lines. That's the scenario that transforms a regional energy crisis into a great power confrontation. It doesn't follow from stated intentions. It follows from incentive structure. Let me leave you with the single most important sentence from our entire analysis. The largest emergency oil release in history was triggered, at least in part, by a choke point that hasn't been fully activated. Sit with that. A single actor with credible but still holstered capability forced a record response from the world's most powerful economic coalition, without firing a single sustained shot. That tells you how much leverage one loaded weapon generates when it stays unfired. It tells you how fragile this system actually is, and it tells you that this scenario isn't really about oil prices. It's about a global economic architecture that bet everything on a handful of narrow channels staying open, and is now discovering, in real time, what happens when that bet comes under pressure. We'll keep tracking the 4 monitoring indicators as this develops. When the tripwires move, we'll update the probability model. If this kind of analysis is useful to you, the kind that tells you what to watch before headlines tell you what to think, subscribe. That's exactly what we build here at futurespathfinder.com. And drop in the comments. Which of the 5 scenarios do you think is most likely? I read every response. It directly shapes what we cover next.